Buy in October and get your portfolio sober.
I like it.
Forget selling May and go away.
Hello, wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome to episode 17 of Wealth Building with Options. I have a special guest today. Our guest is widely recognized as a contributor to financial journalists worldwide, including CNBC, CNN, Money Show, Yahoo Finance, everybody. He's been a researcher and a chief market strategist at a fund. He is the editor in chief of the Stock Traders Almanac, and quite possibly the nicest guy I know. Please welcome Jeffrey Hirsch. Welcome, Jeff.
Hey Dan, appreciate that, man. You're a pretty nice guy yourself. We always seem to have a good time together. Good chat, a lot of smiles. Along with some insightful and, candid market commentary, world events. We seem to cover a lot of bases when we hang out. So good to be with you, man.
Yes, indeed, all the time. So, Jeff, how did you get into this, what I think is a really fascinating world of market cycles? Now, I
Yeah.
know that your dad wrote the first Stock Traders Almanac back in 1967, right? What drove you to follow in his footsteps? Tell me about that.
Nothing really. I avoided it from the beginning, trying to make my own mark out there. And then Dad started this, and he incorporated the Hirsch organization in 1966 when I was in utero. He had started at a place called Indicator Digest back in the 60s with his cousin, my godfather, Samson Coslow, who was a songwriter and a movie producer and pretty cool guy who I had the pleasure of knowing and hanging out at his cool places. And Sam, who we named our first son after, because they ended up introducing my parents. But Sam Coslow sold his music publishing company to RCA way back. And then he got stock for it. Stock tanked. He's like, all right, now I got to figure what's going on here. So he became a student of the market. And long story short, over the years, he did a bunch of things. And then in 1961, I believe it was, he ran an ad in Barron's for this new publication called Indicator Digest, which you may have heard of. It was kind of a proving ground and for a lot of analysts and newsletter writers. So he runs this ad, an A/B split in Barron's. He was an ad kind of oriented guy, marketing guy. And you have two ads on two different presses. One's got one headline, one's got the other. The ad hits. He calls up my father, who was in the songwriting business, music publishing business as well, and said, "Yeah, I want you to come run operations for me." So Dad went there. It was in Palisades Park, New Jersey. A few years later, along the way, he met my mother, who was a widow, and ended up putting them together. But he had this idea, this epiphany to take all these market cycles, patterns, seasonal trends, indicators, strategies, put them all together in a calendar format so that you could follow the market schedule along with your own or his own. And he went and incorporated the business and started putting together the Almanac in 66, came out with the first edition in 67, like you said, right around my coming into the world. Over the years, I worked in the mailroom. I shipped books to everybody. We looked at charts. We grew up, I'd go say goodnight to him, in my pajamas, and what do you think of this chart and whatever? And we had the business was in the house. So I go through my life. I go to school and do a bunch of things, and I'm back in like the late 80s trying to make my way. I was landscaping and working and maybe going into that business and really trying to avoid it. Working with Dad part-time a little bit, helping out with the business. And my buddy says to me, "Jeff, what are you doing? Go work for your father." And this was like fall 89. So I did. And I went in there with demands. I said, "I want a business card, I want a title, I want a salary, it wasn't much. And then what happened was, first of all, my hair was long. You can't tell that right now. My sons both have my long curly hair that I had. I had an earring, a nice diamond that I got from my girlfriend, whatever. But went to my first business meeting with him, and we did a bunch of newsletters back then. It was Ground Floor Stocks and Smart Money. We went and interviewed these CEOs of some company. It was like a Vancouver mining company or something. I felt so uncomfortable with my hair and earring. Next day, took the earring out, got a haircut. And then along the way, I realized I had a little genetics, maybe some environmental connection from growing up with it, where a lot of the stuff that he talked about makes sense to me. And I was getting interesting. I mean, I ran the numbers for some of the calculations in the Almanac using this little ruler and the Barron's Lab pages. I had done that stuff with an adding machine and graph paper over the years. And then there was one meeting, I forget exactly what the topic was, but we were sitting around our conference table. We had, some other writers and analysts there. Dad was pitching some concepts, some new patterns, some new seasonal nuance or anomaly he saw. And everyone was like, well, what are you talking about, Yale? And I was like, I understand what you're saying. And that's kind of when it clicked. This was like the early 90s when I realized that I had a similar thought process, similar way of thinking. I could understand. I had the visualization that he had, the pattern recognition. Not quite the words, smithing capacity, and not quite the iconic thinking, but I think we've done all right and we've carried on the legacy. And it all makes sense to me. I mean, we don't just look at cycles. We look at fundamentals, technicals, monetary policy, sentiment, but our foundation is behavioral finance. It's seasonality, what people do repeatedly with their money over different time frames, whether it be daily, throughout the week, monthly. We find a lot of interesting things happen around the beginnings and ends and middles of things. So people pay their bills the same time every month. They get up and go to work the same time every day. They have dinner at the same time. They have their same holiday celebrations. Memorial Day is coming up as we're talking here. So people are creatures of habit.
Interesting, man. Man, I'll tell you what. When I asked that question, I was like, I know there's going to be a good story here. I didn't know it was going to be that good. That's pretty darn interesting, man. Holy cow.
Yeah, a lucky guy, man. I'm lucky.
Cool.
I stand on the shoulders of a giant, as Isaac Newton said.
Yep. When I think of the Stock Traders Almanac, I think about cycles and seasonality and such. So it's interesting that you mentioned fundamental data points. I think that what we do here at Wealth Building with Options, talking a lot about covered calls and cash secured puts, buying low, selling high with those. I was thinking that we would have a great conversation about seasonality and cycles, which I still hope to.
Mm-hmm.
But before we get into that, what would you say is the most important fundamental data point or data points for selecting stocks from a value perspective?
Price to sales ratio.
Oh, okay. Very interesting.
First thing Pop taught me when I started, we used to look at stocks a lot, call them up. Now I run screens, but the hardest thing for the CFOs and the company to manipulate is top line. So it's relative to either the market or the industry, but generally you want a good valuation is a company that's got a low price to sales ratio.
Yeah, that makes a lot of sense. That's really interesting. Okay.
I know a lot of everyone on the talking heads, everyone talks about earnings. Earnings are important. Earnings growth is important. One of the things that we look at in our screens is a combination of year-over-year earnings growth and sequential earnings growth and repetitive history of that. Same thing with dividend growth and dividend increases if you're looking for those kinds of stocks. But our first screen is sales, price to sales.
Mm-hmm. Very good. Interesting. Let me ask you this. So there is a lot of the seasonal and cyclical data in the Almanac. I mean, do you use a lot of that in your own trading and or investing? And I kind of separate the two in my mind.
I kind of combine them a little bit, and separate them also. I mean, yes, I do. First thing, of course, I eat a lot of my own cooking as much as I can. I find that when I'm making an investment or a swing type trade and I go in to do something at that day, I become a little bit of a day trader. One of the first things that I did calculation wise was, I was telling you before, was the half hourly data ticks. So, if we like a stock, we like to use buy limits, and we don't just buy anything willy-nilly. We want to pick a level that we like based upon the charts and evaluation. So if there's a stock I like, at X dollars, but it's a little bit above that, I'll wait till about maybe 2:30 when you see that. If I don't get it early in the day, that little daily lull to get in there. So we kind of use, I totally use both aspects of the things in the almanac, the seasonal swing trades and the intraday patterns. Sometimes, though, you got to just bite the bullet and go in and buy something that is coming into season and is set up well, and especially if it's liquid enough, you don't need to necessarily use a crazy buy limit below the market. You just go in and kind of split the bid ask, just get in there so you don't get beaten up too much by the market makers. But yeah, we do a lot of sector trades with sector seasonality and ETFs. We have stock screen picks that are also overlaid with seasonality. We usually look for a big basket of new stocks in October, November, right around when we get our seasonal MACD buy signal for the best months of the year. We had a little event back in April in the market where things got kind of washed out. We had been stopped out of a bunch of things along the way using our, sort of risk protections with just basic old school chart analysis stops and things like that. And the seasonal trades we had our best 6 months seasonal sell signal in April for the Dow and the S&P, but we were still hanging on to the Qs, NASDAQ and the Russells, the IWM. They got stopped out just before the Liberation Day washout. But because NASDAQ has the best 8 months, once the dust settled a little bit, we got back in. So we have a nice trade on right now in the Qs and the IWM from, I believe it was the April 17th issue in the newsletter. So you got to keep going back at it. And sometimes things get stopped out. Sometimes trades don't work. But over time, these strategies, these seasonal trades with the technical fundamental overlays that we use have done well. That's why we're here for 58, almost 59 years.
Well, I mean, did you have to adjust your normal seasonality trades because of the tariff stuff and Liberation Day or whatever?
If all things are equal, it's better that one doesn't do that, but there is risk. You have to deal with your emotions and such. And we did put some stops on when things were falling, getting a little bit tumultuous there. Don't necessarily do regularly with the seasonal switching strategy trades because of the volatility, because of the post-election year action that we were seeing. There's some stuff in the current edition of the Almanac, the 25 Almanac. Right now, I'm about to put to bed the 26. So I got two books in my head. It happens every year. But there's a page about the post-election year performance by party. And while post-election years in general have been better than they used to be, traditionally it was first 2 years of the president's cycle were difficult for the markets. But since 85, we've seen post-election years being substantially better and actually the best year of the 4-year cycle because it's sort of a lead up to the midterm year. They wanted people to be happy ahead of the midterm election. But historically, before that, Republican administrations had worse performance in the post-election year versus Democrats in the midterm. They come in and tend to kick ass, take names, get stuff done quickly. They had an agenda, kind of like Reagan after Carter, and they tends to put this uncertainty into the market. So they tend to be more difficult. And whereas Democrats tend to take a little more time to get some things accomplished, and they had to have that midterm sort of weakness. We saw that with the Biden term, with the bear market and troubles we had in 22. So we started out this year looking pretty strong. Everyone's rah-rah. There's a new sheriff in town. And then with a lot of uncertainty starts coming in, and they start trying to change a lot of things quickly. And we had this sell-off. And it sort of came back into that sort of old school Republican administration post-election year weakness. Yes, we've bounced off that. It's been quite an impressive rally, but we're still only about flat for the year. Last I looked earlier, we were getting back up, and here go throw a little technicals at us at that November 6th rally that we had the day after the election. That's, what was it, like 58.70 or something, if memory serves. I think I have that chart here if I remember correctly. So that's kind of what we've been playing with today. It looks like we're threatening to push through that, which would be encouraging for the near-term rally continuing. I think the high that day or the close of the day was 59.29. So it's kind of a level I'm looking at right now. I had put out a little thrust but verify technical look with all the, the Zweig breath thrust and the Lowry thrust and all these technical things that are valid and really show what's going on. I mean, it's just like There's a Yiddish term, tuchus auf den Tisch, or like put your butt on the table, put your money where your mouth is. So that's kind of what the market's doing here. They're really showing people are putting their money where they think it's going. And we've got a nice bull market move. There's some debate about whether this was a bear market or not. I'm not convinced it was. It seems like a bull correction to me, but we've gotten through a lot of those levels that were overhead, and we're looking at that sort of last one right now. So I think we got some room to run here into June. There's also a mid-year peak, this sort of what we call Christmas in July, this NASDAQ mid-year rally, which we've seen a lot recently. And then you get into the weak part of the year, August and September, kind of lines up with some of the post-election year Q3 weakness we've seen, as well as these tariff pauses and people go away. I'm going out to Yellowstone with my wife for some hiking in August. There might be a few less people on the street. We see volume dry up there in the summer. So that's what we're looking at.
Wow. So with all of your, just having studied these seasonality stuff just over and over from a typical year, I mean, I guess, I don't know, maybe outside politics or not politics, maybe outside whoever wins presidency in that whole cycle, like, or maybe including it, if you had to give like a total novice one piece of advice on seasonality, this is the time you should get in to new stocks. This is the time when you should maybe sell some overpriced stocks. What would that be?
Buy in October and get your portfolio sober.
I like it.
Forget sell in May and go away. I mean, it's the best 6 months a year, the best 8 months of the year. We like to get into the equities around September, October when we see the turn. We use a little MACD trigger on that, and then we reposition in May. So this period between April and June, we start to reposition some things, which we're doing. So basically, the best 6 months, the best 8 months switching strategy, bunch of pages on it in the Almanac. That's the first place I go with everybody.
Wow. Okay. So that's interesting. So, I wonder if it might be a better time because you just mentioned that August and September tend to be the weaker months of the year, right?
Yep.
So I wonder if it would be clever to start selling puts towards the end of September.
Now that's why we're here.
Yeah.
That's why me and you were talking.
Yeah.
What are we doing with options? Selling puts either in, and also it depends upon, you have your pattern, and it depends upon the setup for the year.
Yeah.
So we're seeing this rally here, and if we start peaking out in mid-July, is that when you start selling puts at that mid-year, mid-July peak?
Yeah. Or, I mean, if you
Then
think
the old school strategy, which is right up your alley,
yeah.
before there were ETFs, before there were funds, and there used to be wrap-free agreements, what the way people, you traded the best and worst 6 months was you just wrote covered calls against your positions from May through October or during that period. That's the way to go still.
Yeah, I mean, like one of the things that we talk about a lot here is using puts to get into stocks, calls to get out of stocks. So yeah, that could be pretty interesting, going into the.
How would you use a call? I know you're supposed to be interviewing me, but how would you use a call to get out of a stock here, say, for the reposition in May time frame?
Yeah. So looking at that, I mean, especially, say I acquired some stock by selling puts a couple of months ago, right? Which I guess basically I did, right?
Right.
So now we're at a more recent high for the past couple of months, but also just piggybacking on what you're talking about here, repositioning in May. I mean, we could consider selling some covered calls against shares of the stock that we have. And if the calls get hit, if we get assigned, we sell the stock because that's what the selling, that's what getting assigned on the call would do.
You sell it at a strike above the market.
Yeah.
Above the price, above the strike, or
Yeah.
above the underlying price.
Yep.
Whereas for the worst 6 months, the sell in May period, or reposition in May period, whatever, you would write, I believe, the covered calls below the market. So you're just lowering your cost, taking premium, and still hanging on to the stock.
Yeah, what I like
That
to
was the
do.
traditional covered call writing strategy for the end of the best 6 months or the worst months.
Yeah. I started selling some calls against newly acquired shares a couple of weeks ago, and I don't worry about timing it just right. Probably if I had all the information you got in your head, I'd I'd be able to do that better, but I don't. So like instead of trying to time it just right, like I sell some calls, and some of them the stock went up through the strike price, which would mean okay, I'm going to sell the stock. And with some of them I kind of let that happen. But with some of them I just rolled it up to buying back the one that I was short that the stock went through and selling right at the money. Like right now, I am short the 589 calls against my Spider shares, which is, I mean, this will come out in a couple of weeks. So, it's not live or anything.
Right.
So, and they expire tomorrow. So, I mean,
So
if
it's
I
a
could,
traditional option,
yeah, traditional. Yeah.
third Friday.
Yeah. Exactly. Right. This time around it is. But that's just kind of coincidence with stuff like
You have
spiders.
a
I don't care.
589 call on
Yeah.
the Spider
Yeah.
and expires tomorrow.
Yeah. So it's looking to get assigned, which I'm gonna be okay with. And Monday,
So you're selling in May, bro.
yeah, exactly. Right. Repositioning in May.
I know. Thank you. Thank you. Appreciate that. So where do you own that at roughly? What's your cost basis on that?
I was in cash before this moved down, largely, not entirely, but largely.
Right.
And it's not because I'm a genius. It's because I was wishing I wasn't, to tell you the truth. But I was, so I kind of got a little lucky. And I started selling puts on like the 575 strike and skated a few times and then got filled on a little bit, which, because I skated a few times, that premium, I just, in my mind, P&L against it. So I was probably long at 570, 565, something like that. And then once I was filled on those, I started selling the 560 and 555 strike puts and skated on those a few times and then finally got filled. So those I probably owned from 555 to 550. So now, yeah, now I'm short the five, and I was short the what was it, 582, I think, and I rolled those up, took a little bit of loss on those, but then collected more premium on the 589. So I don't know. I mean, at this point, I'm just looking to accept assignment on it and probably sell some lower strike puts. I mean, I don't want to, I'm not a great market timer. I just look at it from a value standpoint. So I'll sell some lower strike puts and keep taking the premium. And if I get assigned, that's great. I'm able to scalp a little bit out and make back what I lost on the roll up here.
So you're not going to cover that. You're just going to let that whatever happens tomorrow.
Yeah. I mean, unless it ends up, I mean, if we're down tomorrow and they're like right at or out of the money and I can buy them back for cheaper than I sold, significantly cheaper than I sold them, then I roll them. Then we're back into the covered call roll, which I do all the time.
You didn't even know you were doing a best worst 6 months options trade, and you were doing it innately.
I, I know.
I gotta not use my dry, serious humor face too much. The wife will kill me.
uh, yeah.
It's
Yeah.
man. So you kind of had the almanac sort of by osmosis in you.
Exactly. I've hung around you too much in my life, I guess.
Yeah.
Uh, so yeah, I guess it probably makes sense to just keep being a little bit more aggressive with calls on any of the stuff that I own. I mean, anything can happen. The tariffs can override. Somebody could have great earnings or whatever. But
Mhm.
I look at it as an extra edge piece. Yeah. So I guess the way I look at it is I can be a little bit more aggressive on selling calls for this period until October. And anything can happen because the tariff thing could, Trump could sign some fantastic deals. The market could really take off. some of the stocks I'm doing it on could have better earnings. Anything can happen, but I look at it as using this seasonality information just to get a little bit extra of an edge.
We call it the calendar edge.
Nice. Yeah. And it's just one extra little thing you can put in your favor. Doesn't guarantee anything, but it helps, right? Yeah.
It does. It's part of it. Yeah.
Yeah.
One of our disciplines, the main one.
Yeah. Yeah. So I wonder if you've ever looked into that. I mean, are there any seasonal or cyclical insights on like market volatility or options volatility?
We did a look at that back in 22 during the bear. And I'm going to see if you can guess when you think VIX, options volatility historically increases. What time of year?
What time of year? Well, I
It's not,
mean,
it's not a trick question. It's kind of a layup.
yeah, I mean, probably September.
August through October.
Yeah. Okay. Great. Yeah. Okay. Makes sense.
So recently we had an uptick in volatility, not in its usual seasonal period of increase. I think that means we probably just had a little bit of a washout, a little bit of a correction. So usually the greatest options volatility is during the weak period of the year.
Yeah. So interesting because October, a lot of people think that October is a bad month, but it's actually a positive month, right?
It's the bear killer, the turnaround month. It was in the 1969 Almanac. I
Oh,
posted pictures of it. Yeah,
wow. I didn't know that was the thing for that
that
long.
was the second edition.
Wow. So I would think that if volatility peaks August through October, and October is the turnaround, the bear killer, October's got to be a fantastic month for selling puts because you get that high volatility that you're selling, and puts have positive delta. You make money when the market goes up. So it's probably a good put selling month.
Yeah, let's get together in October or
Yeah.
in the July peak and start planning out some put selling strategies for the third quarter, for the end
Yeah.
of the third quarter, beginning of fourth quarter.
Yeah. I love that.
Yeah.
That's pretty cool. Okay, so let me ask you this. Are there any like seasonal things that you have found that are surprising or just like nobody would expect this to be the case?
I think a lot of it's out there. Some of those, I guess the most surprising thing to me is the consistency of the intraday trading patterns. Despite all the high frequency trading, algorithmic trading, the rallying of the close, that sort of smart money thing, that weak period of 230 that I mentioned before. That's kind of the thing people don't expect so much that continues, that human behavioral action continues despite all the electronic trading and algorithmic trading and HFT and all that stuff. Some of the things that I find, not necessarily just on the seasonal basis, it's the consistency of the 4-year cycle, the midterm bear killer that we've seen. I guess the line in the upcoming almanac will be midterm is where bottom pickers find paradise. We nailed that October midterm year bottom back in 22. That's kind of something people have trouble believing or admitting. The best 6 months itself is a lot of skeptics. The day when everyone believes it is the day it probably stops working. So the different monthly patterns. One of the things I've seen shift over the years is there used to be this monthly 5-day bulge that Yale discovered, where the last plus the first 4 days of the month where most of the market's gains are made. And then, while I was working for him in the early years, we noticed a shift in that. This was one of the calculations I did by hand as a kid and growing up with the monthly trading days. There's a whole several pages on it in the book. And what we noticed was this mid-month spike that began to appear. And lo and behold, we figured out that it was the payroll deductions, the biweekly salaries or the bi-monthly, where this money goes into 401ks and IRAs and goes right to mutual fund managers in the middle of the month. And they've got to put that to work by design. But lately, we've been questioning some of that monthly seasonality where it just seems to be kind of across the month even. That may be the impact of the level of participation in the stock market and the fact that everyone's coming in all the time now, just buying stocks and buying into the market. So we're seeing some of that monthly cash flow get spread out across a lot of days and not be as concentrated in the beginnings, ends, and middles of the month as it used to be.
Man, like that brings up kind of an interesting point. So you write a new edition every year, right?
Mhm.
So how much do the patterns that you followed over long periods of time from 68 to now, like how much do these things change over time? Are most of them pretty consistent over
Most
the
of them are pretty consistent. The ones that changed, there used to be something called the September reverse barometer. You know, the market did the opposite of what September did. That's not so true anymore, and not at all. That was something we relegated to the indicator graveyard. We do examine different time frames. So one of the things we'll look at is the seasonal behavioral patterns, whether it's for the month over the last 21 years. That's about as short as I'll go because you want to see a decent amount of data points, and 21's an odd number, so you don't get any 50%. And then we'll go back to when NASDAQ started in 71, and then you go back to 1950 or 49. So post World War II versus from the 70s versus the last 21 years. Sometimes we'll look at 30. We'll look at a bunch of different time frames and see if things change. We do that also with the sectors, as well as some of the commodity work we've done. And if you can find a pattern, or when we do find patterns that are consistent over several different time frames, you're onto something there. You're looking for, frequency and magnitude over several time frames. And we also overlay the year of the 4-year cycle, which is important to us. I mean, there's no other country on the planet that reelects or that elects its leader on the same day every 4 years. There's a pattern there. There has to be. There are things that override it, whether it's the dot-com boom or financial crises or whatever, but generally there's a pretty consistent pattern that revolves around the election of the president of the United States as they prime the pump to retain power for themselves or the party and then implement all of their most hard to digest policy initiatives during the first 2 years, and then the cycle continues. So we look at the performance of months for, say, like May. Like May is pretty strong in post-election years, and we're seeing that happen here. So then when we see the beginning of the month, how it's playing out, is it looking more like the typical May or more like the typical post-election year May? Right now, we got a typical post-election year May, which suggests that the post-election year pattern has a bit more importance right now. Maybe it's leading a little bit, driving a little bit.
So you've talked a lot about the election cycles, the 4-year cycles. Would you say that that's kind of like one of the biggest, most important things for people to follow?
It is. It's something that Yale brought into the Almanac in the beginning. It's something we kind of put on Wall Street's map. There were people that had dabbled in it and researched it. There's earlier research on it, but we really are strong proponents of it. And I think it's very important. You're seeing it magnified right now with the market basically responding to everything that comes out of the Trump administration's announcement. You got to follow Truth Social now to see what the market's going to do. I mean, you got to see whatever it's on steroids.
Yeah, makes sense. Makes sense. All right, so we've palled around the country like a bunch in different places, Vegas, New York, Miami, at these trade shows and all that business,
Mhm.
all over. And I recall some pretty good conversations about music. And now I kind of see maybe where you get that interest from, which is
Yeah,
interesting.
yeah.
Yeah. Uh, so the one thing that I was looking on your LinkedIn profile to write the intro here, and I
Mhm.
saw you produced a play. Did I read that right?
Yeah, we didn't quite get it fully aired, but it was a musical
Wow.
that my father wrote. It
Oh,
was about
wow.
the Elephant Man. Um, Way back when I started in the beginning with my father full time in 1990, we had this Gulf War, the Kuwait War in
Yeah, yeah.
1990. So, it was a pretty trying time. There were those daily news briefings with Schwarzkopf and all that stuff. And I guess Dad was inspired. He had read, or maybe I think he saw the movie. I guess it was the Mel Brooks directed the Elephant Man movie. I think that's what it was. But
Huh.
he was moved by the relationship of John Merrick and the woman who came to see him, Melissa. So he wrote this musical, Merrick and Melissa. And I was living at home back in my old room, started working with him, and the piano was right over my head. So I remember I was actually reading Lord of the Rings for fun at night, just to relax. And he's playing. He's got his foot on the sustain pedal, composing. And he and I had a lot of discussion about music over the years. I'm pretty much a rocker, though I like jazz and shows. I've been to a lot of Broadway. I can be a bit of a critic, but it's just some pretty cool stuff that he wrote. The music was good, the lyrics were good, the songs were good, and then over the next bunch of years, he put together a whole score and a book, and he had other guys come in and help write the book with guys who were Elizabethan period piece people, and when I started to take over the business, I decided to try to produce this. So we put a bunch of money into it. We had a reading out in Hollywood at the North Hollywood Arts Center, and we had a maestro, and there was all kinds of stuff. We had artwork done, and then it just kept sucking more money. So it was like, well, unless I get somebody like Elton John or whatever to come in, or somebody big to take it over, I budgeted about as much as I wanted to, and it went as far as it went. But it's still there. I still have the score. If somebody wants to produce this or wants to help fund it, I'm happy to get back into it. I just, being a novice, a rookie in the Broadway business, it was kind of hard to break into, but we gave it a shot.
Yeah. Wow, man. That's pretty darn cool too.
Yeah. Oh, when we did a demo disc. We had you remember the guy Tom Mopat from the Dukes of Hazzard, and he did Music Man and other stuff on Broadway. The guy who was our conductor and collaborator, he is in the business. He was a pro. He brought in some real singers, real Broadway opera singers. That was the one name that people would know. So I have a recording of about 4 or 5 songs, and it's great. And there's some duets. So there's a female part and a male part, and there's a whole carnival scene. It's a great story and a great book for musical. And I still have some CDs around.
Awesome, man. Well, Jeff, anything you want to leave our listeners with?
Well, it's a volatile period here. Yes, we've got a nice relief rally, but ride it through the end of the best 8 months and be a little cautious going into Q3. I think maybe, Dan, you and I will be writing some puts come this August, September, October, but be a little bit cautious for the rest of the year, though I think we'll end up positive, just not as much as we all initially thought.
All right. Well, thank you, Jeff, for sharing your time and your knowledge with our listeners. That was really, really great stuff. That'll help guide us on making our covered call and cash cured put trading even better.
Appreciate you, Dan. Thanks for having me, man.
All right. And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And when you do, you'll be the first to hear episode 18. And you're going to love it. I'll see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.